Doug, welcome to another week of hanging out and talking about the markets, the economies, and the world in general. What do you got on your mind today? I'm going to share a disclaimer here. I had to change the disclaimer this week a little bit. I said last week, FDIC coverage has limitations. And this week I said it possibly has limitations. So there we are.
Yeah.
A lot can change in a week.
Yeah, that's an interesting statement. FDIC coverage possibly has limitations. You want to explain what you mean? I'll tell you what I think.
Well, we went into last week with the advent of a likelihood. I don't think that Silicon Valley Bank had failed yet. I think we were talking about that the stock price had dropped dramatically. They halted trading, had a run on the bank, and over the weekend, the Federal Reserve and the Treasury decided that we would expand FDIC coverage to people who actually didn't have it after the fact. They changed the rules after the fact, and that really was makes it really hard to play games if you change the rules as you're going.
Yeah, it's interesting. So it's Friday, and yesterday, thanks to one of our friends he's a great thinker. He came in and offered us his opinions and thoughts on artificial intelligence. I don't know if I'll just say artificial intelligence, like Chat GPT. And we walked through how to use it, how to get Chat GPT to think deeper. And so this morning I was asking Chat GPT all these questions about the FDIC. And one of the replies was that over FDIC limits, depositors are not likely to be bailed out.
Not likely. Well, that's because it doesn't have current information.
Yes,
right?
That's exactly right. And so even that what is it? I forget the semiconductor guy who said that technology is evolving quickly and all this stuff. But it's not evolving quick enough, because in 1 week's time, less than 1 week's time, Sunday to today, it is possible, maybe even probable now, that the depositors of any financial institution will be bailed out.
Yeah. Well, I brought show and tell today, Doug.
And okay, so
Let me
Keith and we do not talk, we don't plan like what we're going to say on this show. That I turned around to see Keith's desk full of these piggy banks, and I got so excited, Keith, because I want to do a special video on the difference between maturity and duration for you guys. And I was thinking through, how would I explain that? And these piggy banks came to mind. So I can't wait to have this discussion today. This is fun.
Well, I think like the discussion starts, which Eric was telling me earlier, he doesn't even use this stuff that's in here. So really, these are probably obsolete that we've got these little banks here, because the kids, newborns today, probably won't even have anything to put in these before.
No, we should have a bunch of these.
Yeah, but like this is 25 cents or $0.25 is what this coin represents. And if this is the Federal Reserve Bank here, there's a number of Federal Reserve banks. If you're in St. Louis, there's one downtown St. Louis. They made it look solid and secure. Cool. Yeah. Really cool. And so the Federal Reserve is not a government agency. It's a banking thing that's privately owned. And the Federal Reserve can create money, and really, but it can't create value. That's the important thing. Money is a store of value. And so as you go to work, as you create things, you're creating value, and we're all trying to figure out, how do we store our value? And if the money system is stable, then we can store our value in things like this. And these little banks around, these little piggies around the country that circle around their particular Federal Reserve Bank, they borrow and lend money to one another, as well as borrowing and lending money to you and me. And what the Federal Reserve can do is they can just say, you know what, I think we're going to make 500 billion.
Can't see.
Yeah. So they're gonna make 500 billion, and this is gonna be
Throw it in there.
it's gonna be an IOU is what it happens that quickly. It's electronically. And so really it says we're gonna borrow against what we have, $500 billion, just like that. And it doesn't create any value whatsoever. It creates more money. And so money is a store of value. And so the more money they create, the less value that all the money has. And so why I put this back here represents the Treasury, who actually prints currencies and bonds and things like that. So if you have the printer back there and you can print more, it makes all of this money is worth less. And all these banks are navigating, how do we manage all this stuff going on? And so that's a very elementary description of what's going on, but I thought it was kind of pertinent to do that because what I saw this week in a very short order. Let me share the screen with you all. This is the balance sheet. So a balance sheet is your assets and liabilities. And this shows, this goes, I didn't give you a very concise one, but this one goes back to 2020 in the recession from the COVID lockdown and the pandemic handling by our federal government. Notice I don't say the pandemic, but the pandemic handling by our government, because those are two separate things. And in the balance sheet, or the amount of debt that the Federal Reserve had, was a little over $4 trillion. It went up to $7 trillion in just a matter of months. And then it worked its way up to $9 trillion. And then they've been tightening the money supply, taking money out of the system. And it was working its way down, but you can see not very fast relative to what happened over here in 2020. And then last weekend, there's a blip here that they created more money to try to resolve the problems with the banks that were challenged. And so that's just maybe my ranting about the central bank and really what's happened, I think, in the last decade is that this bank has become more of a political entity rather than somebody that's trying to stabilize our economy. So
yeah, there's a lot of power in that. I mean, to think that Silicon Valley Bank stopped trading on Friday, or was it Thursday afternoon?
I think it's Friday morning it never opened. Yeah.
And then before Monday, before the stock market opened, there was a solution Sunday night.
Yeah.
I mean, there's a lot of power in someone's hands to be able to pull that off that quickly.
Right. Right.
When you were doing this, though, I kept thinking about Lloyd Christmas. Do you know who Lloyd Christmas is?
No, tell me.
Lloyd Christmas was the character on Dumb and Dumber, and he was not very good at wealth creation. He and his buddy Harry, they weren't good at making money, but they were great at spending money. And they would put IOUs in a briefcase, kind of like this. And one was for a Lamborghini or something like that. And he said, you might want to hang on to that one. And so, I mean, that's the same thing we have here. So we've got a lot of IOUs, but the government never creates money. They never generate any wealth, any ideas, any solutions, any products. I mean, that's you guys who are doing that kind of stuff. So to put our trust in them into a system that's in debt, what, 32 trillion?
It's a lot.
To bail out a bank that was in under 175 billion.
And
kind of interesting.
It's an interesting thing, because really what money is it's the store of value, right? So it's not a quarter. This could be worth nothing at some point, right? Like this quarter could be useless. But I'm thinking of Venezuela. I might be wrong, but in Venezuela, they were having runaway inflation, and they would take the currency they had and they go out and buy things like this because they thought this would hold value better than this guy would. And these things hold value, what, a year at the most? They hold some value, and this you would like to think would hold it longer than that. And so what you see people doing when the Federal Reserve and the Treasury doesn't look out for the best interest of what they think themselves, when they're looking in the mirror, do I trust them? Do I trust my bank? Do I trust these guys? Who do I trust? they start moving where they want to move their money. They may move it into their mattress. They may go buy some electronic things. They might buy fancy pens. Everybody has to think through what gives them safety and security.
Yeah, and like this little note in here, that there's a secondary value or system for this where these can be traded. And so, like Keith mentioned, the phones. This is a hot commodity today. I mean, I could trade it. This is an old one. I could trade this in and it'd be sent somewhere around the globe. And this could shift and go to economies that don't value this. And so, yeah, assets have value, they have meaning. And I think that's one of the moral hazards of what's happening right now, is that there could be a shift of expectation of what happens in the future.
I think education, I'm going to get on a soapbox here. Education is not being honest to our citizens either when they propagate the idea that socialism is a really good solution. And in 2008 financial crisis, one of my daughter's teachers told her that that he and his wife were not affected by the economy because they were both teachers.
Okay.
And I had to kind of point to I can't remember what grade she would have been in, but I had to point out to her that this teacher doesn't understand history, doesn't understand how the economy works. Even if they are an economics teacher, they may not understand it, because in the Great Depression of the 30s, this is how teachers were paid. They weren't even given this. They were given this. And so you can't spend this. You and I can't spend an IOU at the grocery because they're like, I'm not good. And so just even the learning process, maybe that's what I was motivated today, is to do a little education of how some of this works. And I'm not angry or anything. I'm just saying it is what it is.
Yeah, it is what it is. And that poor teacher's paying 50% more for eggs.
Right. Well, and shortly after that, the Indianapolis, like within a week or two, the Indianapolis public school systems laid off a big number of teachers. And I had to take that headline out newspaper and show it to my daughter to help her understand. You have to think, like, you can't just trust what somebody's telling you. You have to think about what's really going on. So yeah, it was really an interesting week in the world. I think one of the great ironies, because all this is based on trust, right? Like all this is that we have to trust that somebody's looking out for our best interests. And one of the great ironies is one of the banks was called the Signature Bank. And in the day, your signature had value, right? Like your character and the irony that the Signature Bank was the one that went under is just thought-provoking in and of itself. What else we need to do?
I want to just congratulate everybody. If you're listening to this call, chances are you're an investor and you've placed your trust in some type of system of investing. And I don't know what it took for you to build up your investment accounts, but it took a lot of discipline, took a lot of faith, and over time, you've done well, and you're doing well today. And so I want to congratulate you guys who still are chugging along and have faith in the system. We haven't gotten a lot of calls this week.
Yeah, and that doesn't mean you can't call us. Please do. Like if you've got questions, we're here for you.
I think the reason we haven't gotten a lot of calls is just because of you, just because of the way that you've handled your money. You've been responsible. You've spread out risk. You're not greedy, and those things combined just kind of make it another day.
And we appreciate we were able this week to do a quick video on our initial opinions on the banking system, and that's on our YouTube channel at Gimbal Financial. And we'd love for you to click like and to share that if you have friends that have concerns. It's a real short video that might express some ideas with that. I did some research this morning, Doug.
It's a pretty chart.
I made that chart. I didn't borrow that from anybody. This is my chart here. I just want to put the banking system in perspective for you. And first of all recessions were called depressions over here in this time frame in the 1930s. But I think that recessions were kind of more of a blip prior to this Great Depression. And so instead of calling future recessions depressions, they started calling them a recess, like a recession rather than a depress. And so if you kind of keep that in mind, I've seen some videos and people, talking about the word depression as though they're really anxious about some, craziness going on. And so a recession and a depression are the same thing. It's just the magnitude of them. And so that's probably the critical thing to keep in mind. And the magnitude of the Great Depression, we had 4,000 bank failures in 1 year. And I don't even know, I didn't look at the numbers enough. We probably haven't had 4,000 since that 1 year. And if you kind of see the magnitude of the number of bank failures that went on then, you can see some little, jagged things here. And then I think a lot of people forgot about the banking crisis of the late 80s into the early 90s. And it was pretty dramatic. There was a Federal Savings and Loan Insurance Company that went out of business, was absorbed by the FDIC. And I would guess most people didn't realize that was even going on while it was. I mean, the economy was struggling and there were some things that went on there, but there were a lot of bank failures then.
Probably a lot of bank mergers through that, where banks came together and increased the strength of their balance sheets.
Yeah, and you see that over and over again. We had the Bank One Tower in downtown Indianapolis. I don't even know who's named on that tower now. Salesforce now. So it changed names from time to time. And then here is what they call it, the Great Recession. I think that was even named with some naivety.
That's a little strong, maybe.
Well, yeah, because I'm pretty sure the stuff that was going on over here was a lot worse than went on over here. And so it might have made those people that don't have any history feel like they've lived through a really difficult time. And it was challenging, it was nothing like what was going on here to the left. And so we've had 2 failures in 2023. We had failures in all this time over here, not enough to even raise the bar relative to this grid. And so I'm not making light of the bank failures that have gone on. I think my opinion is the Federal Reserve and the Treasury probably overreacted, is that the economy historically can absorb poor management. And that's what happened, right? Where is it? Over here, right here. The whole problem started by a single bank making bad decisions, and then it scared depositors into these other ones. And they can move their money now. Instead of lining up out in front of this bank, they can move their money with this. And that changed banking probably forever. I think that idea that you can have a run on a bank that quickly and you can't lock the doors, you can't shut the doors, it's coming electronically at you, is probably what we saw happen this last week, which is everybody needs to learn to adapt and to do new things as time goes on. So the banking industry will have to evolve from that.
I think we're going to be talking about this for a while. There's a lot to learn, but could we dive and take a look at the markets, see how the markets have reacted?
And when I was new in the business, I did a seminar called Be the Bank, and I was teaching investors how to be the bank, because the bank simply makes the spread between what interest rate they lend money out and what interest rate they borrow it. And in that seminar, I pointed out how banks consistently screw up over history. You get greedy and they blow up, and that's part of it. And so, yeah, the banks, just because they're a bank doesn't mean they're going to make the greatest decisions. So
that's the tough part. If we're going to start bailing out everybody, it leaves the mind to wonder, what would a bank do to increase more share?
Right. Like if I can't manage my own checking account, there's a term for that. It's called bankruptcy. Right. And what happens is people don't entrust me with more wealth anymore because I can't manage what I've been trusted with. So if we bail out a bank who can't manage what they already have, it sends a message that foolishness is rewarded. So anyway, let's look at the market.
So here we have the S&P 500. This is a great representation of what's happening in the U.S. stock market. A lot of these companies are global, and they've got operations all over the world. They have currencies that they're sorting out at the end of the day to right the ship for their earnings reports, their forecasts. And the S&P 500 is it's where Keith and I like to start. It's a great gauge of what's happening with stocks. And as you can see, if you look to the right, we are close to the black line that we've been talking about for 3 years now. Keith, it was in 2020 that we started doing these Zoom
Wow.
calls. And March of 2020, and probably like this day, 2020, was a very interesting time because we've been selling a lot.
Yeah.
And let's just go back in time. Click on 2020. Thank you.
Whoa.
This is 3 years ago today.
Wow.
And,
Yeah.
and you can see this was just so brutal. But below the black line, bad. Above the black line, good. And what we've seen here recently is we've seen a fight for the prices along the black line. And so this was where we were just a couple years ago. And hey, we've rebounded. We've made a nice rebound. And so if you want to forward out to, unless you have something else you want to address on this.
No, I just when you have these kind of free falls out there, they can create a similar kind of thing where people line up at the bank. They can create people lining up to sell stock. So that's when everybody panics and sells stock, it's the same conceptual idea as a bank run.
Yeah.
Only it doesn't really require too much government intervention.
No.
There's some stops they put in place at the different marketplaces to limit how much the market can drop in a single day. But that was definitely a panic that was going on there.
And this is one of the things that we appreciate about the stock market is you can call up and say, give me my money from 9:30 to 4 o'clock. You may not like the price, but you've been able to get your money. And so here we have the prices. The prices currently, if you look all the way to the right of this chart, they're fighting for the 200-day moving average, and that's great. Don't have a problem with that. But about a week ago, we just weren't sure what this would look like, and capitalism has the last couple of days, I think, looked pretty good. And some of the reasons where the S&P 500 looks to be a little strong or like it's fighting that 200 is because of innovative companies. The technology companies have really been leading the way, and we'll see that here if we take a look at the NASDAQ. The NASDAQ, yep, it's a little stronger, as you can see in its price movement over the last couple of days. And so those technology-oriented companies within the NASDAQ and within the S&P 500, there's less in the S&P 500, but they definitely helped. And that's been a positive thing. You want to explain this chart?
Yeah, this is S&P 600 smaller companies, which would reflect a good number of the banks that are out there would be the smaller companies. And so the drop off from this thing from its February high from 1320 to 1148, that's a pretty substantial decline already this year. And I think historically, when you're coming out of a recession, these small companies tend to lead the way. But if you've got a representation of the banking stocks in there, let's see if I can give you an example of this. This is still showing up on our charting software, and so here, this is the bank's super regional. And if we just use this as what we've been talking about as a indicator of what to do with a stock, and we use this 200-day moving average over here on the super regional banks, they started showing problems back in January, along with the market January of 2022, and they set up a pretty substantial trend line right here. And they weren't saying any reason to hold on to those things. They rallied it right up to the 200-day moving average over here in late January, early February, and couldn't make it. And so the index of banks itself is saying, this is probably not the best place. I should have an FDIC insured rather than have it in their stocks, is what it said. And then you have this gap down right here. And we would say this is not the time to buy stocks or bank stocks at this point. We're not making a specific recommendation. We're just saying there is a lot of jockeying going on. If you look at, we've talked about over those last 3 years, or this data down below this red line is the amount of shares that are trading. and we've not seen anything like this kind of volume. And so there is a tug of war, like I talked about across the Mississippi River last week. There's a major tug of war going on with bank stocks, super regionals, and that trend doesn't look to be that the buyers are winning that tug of war right now. And I'm going to punch up a money center bank real quick and look at how those are trending as an industry. It's not cooperating with me. Let me see if it'll.
And on the specific stocks like this is not a recommendation to buy it. If you've got a dump truck load of shares, it's not a recommendation to sell it. We need to talk with you on it.
For some reason it's not wanting to show me number 118. Let me try it another way. I'm gonna stop sharing my screen for a second here, and Doug, you can offer some other wisdom while I'm trying to find that particular index.
Well, we talked a little bit about the hazards of bailing out one bank, and what that could potentially lead to is just an unbalanced approach. And there could be a few banks that are favored over others. There's a lot to wonder and learn, and the prices of these banks this week have reflected that thought. So you have these super banks that are out there, and these are the big ones. These are the big ones when you're watching the NCAA tournament. They are the advertisers. And then you have the regionals. Those are the ones within your geographic area, maybe like the Midwest region, the Southeast banks, the Southwest banks. Then you have your smaller community banks. And man, we are for you, small community bank. We like the way you handle service and the way that you do business. But it's going to be tough for those guys.
It is. I got us to the money center banks here, and again they dropped below the 200-day, and their trend was kind of going down at a pretty steep slope as well. And then they even started showing some strength. So somebody was saying, if I got to have money in bank stocks, I'd rather have it in the money center ones, because if you recall what we showed you a second ago, the ones that the index, I forgot even what that one was called, the super regionals, it never made it above the 200-day moving average. And here the money center banks they've given back the 200-day moving average here in the last week, just like most banks have done. But that's kind of what I sense the government and the Federal Reserve was saying is, we want you to move your money to the money center banks, which I'm not a big advocate of that. That's what I heard them saying with their decisions. They didn't say that out loud, but they sure put a lot of pressure on those smaller local banks. And so it'll be interesting to see how that unfolds.
I think one of the greatest things about being an investor is it's like going outside in the weather. I mean, some days you're going to put on a coat to stay comfortable. Other days you're going to wear shorts to stay comfortable, but you have choice. You have choice what to do with your money. You have choice what to do with how you go outside. And the elements are risky out there. No one needs to tell you that. But you need to be dressed appropriately. And that's what we want to help you do. We want to help you stay comfortable.
And I think capitalism will trump through all the noise,
all
this noise.
If
Capitalism.
we let it.
Yeah, I think it'll work its way through. In that one blip I showed you on the chart that I made in the 1980s and 90s, where there were a lot of bank failures. The brokerage company I was with at that point in time had this thing called a bank stock index, and they were compounding money consistently for investors, to the point they had brochures about it at 25% a year, which is a really high number.
Amazing.
They were doing that until they didn't. And it was a bank stock index during that time where that little blip was. And all of a sudden, some of those banks' stock prices started, major banks, not money center ones, but big banks, started going towards zero. And instead of giving a sell signal, what the brokerage company did is they just pulled the plug on that bank stock index and quit giving us, the advisors, any advice on what to do. We're staring at I'm staring at I'm a young guy, my voice went up a lot. I was like, I'm not sure, Mr. Client, what to do here. But that is, it really taught me at a young age that if I'm helping you with your resources, there's not somebody above me that's going to help me give you advice. I can't rely on the Federal Reserve to give me advice. Can't rely on the Treasury. My banker may be able to try to help me, but at the end of the day, having wisdom to help you make decisions, to protect capital, to deploy capital at the best reasonable place in any given market. It really is a personal relationship between the advisor and the client, I think, and it's a big deal. We take it personally.
Yeah, fear and greed are not great tools for managing money, and let price be your guide. Jiminy Cricket, let price be your guide, and just don't argue with it. Just observe it on the charts and talk with us about the prices. And you all are doing great. Just keep up the good work. Keep doing the stuff that you've been doing that brought you here.
Yeah, thank you very much for your business. We are grateful for your business, for your friendship, and your willingness to entrust us with this segment of your life. It's a big deal to us.
See you next week.
Bye-bye.